Okay, and to finish this chapter off, I want to talk about a couple of different situations or different ways, times where you might account for things in a certain way. One of these is decentralized companies. And so this is generally when you have a big company that you want to split into more manageable segments. Manageable segments. So, for example, it might be JCPenney's, and so if you try to manage the whole thing, it's almost too big. So there's different ways that you can split it up geographically, or sometimes we split things by process, that kind of thing. So we might split the retail thing from the catalog thing from the website, something like that. So advantages to this, it frees up top management. And this would be, I would free up top management. I'm going to go ahead and fix that so it doesn't bug me. Frees up top management so that they can focus on big picture things like growth without having to do the day-to-day operational type things. It allows people to specialize, and so they don't have to be experts in everything. They can focus on what they are good at or what they know, or especially when you've divided up by process, you don't have to know everything. You're just focused on, I don't know, web design or whatever without having to do everything. It allows a lot of times for better customer relations because you've got somebody kind of local or somebody that knows what they're doing. And it can also help with training. Again, you can be more specialized. You can do this. Also, people can cross-train. Sometimes this is motivational for employees because they see that they can move up to different areas within this, which can also help with retention if you can kind of promote from within. Of course, it does have its disadvantages. I just cannot spell today. I can't, now I can't erase either, sorry. So disadvantages would be you can have some serious cost duplication here. So, for example, if every geographic region has its own HR department, then you have a lot of HR managers as opposed to one. And so some of these costs you're going to have a bigger structure, so you're going to have some of these costs in there. You can also have a problem here, lack of goal congruence. What this means is people are going to do what's best for them or their department rather than the company as a whole. So if I'm just measured on how my department does, I'm going to do what's going to make my numbers look better, even if somebody else down the road is going to end up paying for it. And the company's going to suffer, but as long as my department looks good. So that's tough. That's why you see places have incentives based on overall profitability of stock, or the stock price, or stock options. If you're getting rewarded based on ownership of the company, then that says that you will then make your goals what's best for the company, not just your department. Whereas if you just get incentive if you come under budget, then that's what's going to drive your decisions. And so that's basic human nature, but something you need to consider when you're setting up the structure. Responsibility accounting means basically that people are going to be, you're going to measure someone based on what they have control over. So you've got a couple different things here. You have a cost center, and these guys are only... they can only control costs. They don't have anything to do with revenue. So a cost center would be like a production department. They just produce. They're responsible for costs. So the manager is responsible for just controlling costs. They're not anywhere in the revenue. If it's like JCPenney's we were using, it might be the maintenance staff or something. They don't have anything to do with revenue, price setting, anything like that, just that. So a revenue center would just be in charge of generating revenue, and they don't really worry about costs. Generating, this thing's driving me crazy. So generating revenue is the only thing that they're worried about. So a sales office, or if it's our JCPenney thing, it's like the catalog counter or something like that, or the 1-800 number. It's basically just generating revenue. A profit center, the manager there is responsible for controlling costs and generating revenue. So this would be like a grocery store, or the manager of the JCPenney at the Valley Mall. So the manager of that store is responsible. So whereas one department might only be revenue or cost, the manager of that store is responsible for both of those things. And then we have an investment center. So these guys, in addition to the revenue, the cost and the revenue, or the profit, they are also responsible for long-term assets, and investments. So this might be the regional vice president or something like that, who would be in charge of whether we're going to build a new store. So long-term assets like your buildings and your plants or distribution center, they would be in charge of making those types of decisions. So you can kind of see where it follows up there. Performance evaluation systems are again what we're trying to do. The goal of any system, we're rewarding people, how we evaluate people, and often how we reward them. The goal of any of these is to promote that goal congruence that we talked about. We want them to do not what's just best for their department or what area they're responsible, but what's best for the business in general. So promote goal congruence. And coordinate the different departments, the different areas. It's important for you to communicate expectations. You can't hold people responsible and not tell them what they're responsible for. This should be something that motivates, which is why there's generally a reward in with it. Again, the goals need to be challenging but meetable. If you set goals that are unrealistic or unattainable, then they're not going to motivate people at all. People should also be given feedback on these, where they're meeting and where they're not. If probably where you work, you have some sort of performance evaluation. It might be yearly, it might be semi-annually, and you want to make sure that each person's goals align with the strategic goals of the company, and all that. So some limitations of these systems, some common limitations. It's often just financial. So, are you coming in under your budget? And you might say that there's other things in there, but a lot of times that is the main thing that people are, how productive are you? It all gets down to numbers, really. But that's what keeps a business in business. There's a time lag here. It's always looking backward. Most of these really don't look forward because they're based on facts. And most of them have a rather short-term focus. What happened last quarter? What happened in the past year, rather than, you've been here 30 years. And the other thing is, even if there's an annual review, a lot of times the whole thing is really just based on what happened in the last 3 months. And so it shouldn't be, but a lot of times it is, depending on how the system is made up. So things that, systems that are out there, the balanced scorecard is one, and it looks at how your, you'll form KPIs, key performance indicators. And so we want to look at the financial things. your budget, your productivity, all that kind of stuff. We also want to look at it from the customer's point of view. Are you having a lot of returns? Are you getting a lot of complaints? Are your customers happy? The internal business, the people that other departments that you work with, are you receptive to them? Are you responsive? That kind of thing. And then there's generally a thing on learning and growth. What kind of professional development are you doing? What are you doing to try to make yourself better and all that kind of stuff? But one of the key things when you're designing some sort of system, because this has huge behavioral implications, people are going to always try to work the system in a way that's going to benefit them the most. And you have to understand that when you're setting the system up here. One of the big things is you have to look at controllable versus non-controllable costs. It is completely unfair to hold somebody responsible for costs that are outside of their responsibility. And so you have to understand the cost well enough to understand what they can control and what they can't. So they could say, well, my supplier raised the prices, that's out of my control. But if it's their job to look around at different suppliers and they just didn't feel like doing it, then that is controllable. But some things are not. It's not somebody's fault if we went into a recession. It is their fault if they didn't have contingency plans, for example. But you have to make sure you're only measuring people on things that they have control over. They don't have control over things that are coming from a different department. So if I'm the production manager and I've got a lot of waste, but it's because the purchasing manager bought cheap stuff, that is not my fault. And so that's the kind of thing we have to look at here. So let's see. Investment centers. So if you look at some, there's some examples in the book on responsibility reports for cost centers where you'll just look at costs. And again, these are going to be based on the variances that we did. Same thing with the revenue centers and the profit centers. Those variances that we've been looking at in the budgets from Chapter 23 are what we look at there. With the investment centers, it's a little bit different. They are the goal of an investment center is to maximize the amount of operating income and to efficiently use the assets. So on these, we look less at those variances and that kind of stuff and more at some of the financial indicators that we've looked at. Return on investment, profit, margin, ratio, asset turnover ratio. These are ratios that we've actually looked at throughout the rest of the book. That kind of at the end of each chapter they throw in some financial ratios. And then another one is residual income. I'm not sure we've actually looked at that one. And residual income is operating income minus target rate of return, how much I wanted to get, minus average total assets. And so that's how much you have left over there. So some drawbacks of these is that non-productive assets are going to be ignored in here. It's really just one point in time. It doesn't really show us a change. It can have a very short-term focus. Sometimes people will change things right before these assets are calculated, and so that can be a limitation as well. But let's just look at a couple of these. The corporate division, which corporate division is more profitable, the domestic or the international? And so if we look at ROI to determine profitability, there's a couple different ways we can look at that. If we look at the domestic, ROI is operating income over average total assets. And they've actually, remember, that's the beginning plus the ending divided by 2, and they've already calculated that for us. So for this guy, the operating income is 10 million. divided by average total assets of 24 million, and so I get 41.7%. And the international, same formula, 11 million divided by their average total assets are 32 million, and so 34.4. So even though they have a higher operating income, their assets, as a relation to their assets, it's actually lower. So we can look at this guy here. We're going to do the profit margin ratio for these guys. So the profit margin ratio, let's see, profit margin ratio is the operating income over net sales. So for the snow sports, their operating income is 990,000. Their net sales is 5.5 million. So that gives them 18%. And then the non-snow, their operating income is 1,530,000, and their net sales is 8,500,000, and so that is 18%. So they're equal as far as profit margin ratios. Now we can kind of continue that and say, all right, well, let's look at their asset turnover ratio, and I think we're also going to recalculate the ROI for this guy here. So asset turnover is net sales. It's probably been a while since you've looked at these, but average total assets, which they've also given us over here. So for the snowboarding, or for the snow sports, we've got net sales of 5,500,000 divided by average total assets of 4,100,000, and so I get 1.34. And for the non-snow, I get 8,500,000 in net sales divided by average total assets of 6.1 million, and I get 1.39. And the expanded formula says if you take the asset turnover ratio times the profit margin ratio that we calculated here, which is 18% for both, times 18%, I get 24.1, and over here times 18 is 25.1. And so what this means is, even though they have the same profit margin ratio, the fact that this one is turning it over a little bit faster is what's yielding that higher return on investment. So that's kind of what that means, and that does make sense with this one. So they're both yielding the same profitability essentially, but one's turning it over more, and so that's going to give you a higher return on your investment. That means they're using their assets a little bit more productively. And then the last one asks us to compute the residual income. So residual income is the operating income minus target rate of return times, I think I said minus average total assets. Wait, let me go back here. I think I wrote times average total assets over here. So for the snow sports, The operating income is $990,000. The target rate of return, I think they gave us that in the beginning, was 13%. And the average total assets over here is $4,100,000. So that comes out to $533,000. So I get $457,000. And for the non-snow, their operating income is $1,530,000 minus 13% times their average total assets is $6.1 million. So that gives me $793,000. So that is $737,000, which is kind of telling you how much they're earning above the target rate of return. And so, and it does make sense because this guy has the higher ROI, and so we would expect him to have the higher residual income as well. So that's kind of how we evaluate things on a big picture level. So on this, we've looked at everything down from variances on individual costs for a specific wage, all the way up to big picture things. So it's everything from evaluating the most minute detail to evaluating big picture performance, all in one thing there. And that is chapter 24.